Dom Chu joining us now. The NASDAQ is up 3%, 490 points. Like, oh, the markets are well off their highs. That is a gigantic move and a weird market.
I told Kelly the same thing at the top of the last hour. I said on any other day, if I told you that the Dow was up 1,000 points or that the NASDAQ was up by 3 to 4%, you'd say, holy moly, my 401k is doing great. But in this environment, it doesn't seem like all that much because we see 1,000-point swings, yeah, and I want to almost quasi-regularly.
And he knows. He used to run money. I want to say this before we get to Market Navigator. I got a lot of friends that work on Wall Street, hedge funds, prop desks. They're happy right now. Okay, I want to be clear. You know who's winning on this? May not be mom and pop, but Wall Street, I think, is winning, right?
If you're a trader and you bet on swings up and down and you profit on transactions and volatility, then you kind of like what's going on right now, I think. But I mean,
now listen to this guy.
Listen. So the other part that's weird about this is that the bond market hasn't been acting the way it should be in these kinds of volatile moments, right? We can say yields have gone higher and everything else. So the safe havens have not really been safe havens during this volatility. But our next guest actually says he thinks that treasuries can still be used as part of a strategy to safeguard your portfolio from possible economic threats down the road. So joining us now with the case is Manju Boraya. He's the head of systematic edge fixed income at Allspring Global Investments. And Manju, you're talking treasuries, but you're not just saying buy treasuries outright. You're talking about a dynamic that could be developing. What kind of a dynamic are you talking about?
Hey, Dom. Hey, Brian. Good to see you both. So the dynamic, as you pointed out, is really around this notion that the treasuries haven't actually played the safe haven role that they typically play, especially the long end of the curve, right? So what you're seeing in the economy is going through a heightened uncertainty, and that uncertainty is actually means that there's upside risk to inflation and downside risk to growth and employment. And as the Fed chair recently stated last week, the Fed is actually going to, is well positioned to kind of basically wait and watch, right? They're going to wait and watch to see if there's going to be uncertainty around the trade policy before they make any changes to the underlying, monetary policy rate. So given that, I would say the dynamic is really what is happening with the curve is that we have seen two factors. So one is the repricing of the term premium, right? So what you've seen is the events of the last few days have actually fundamentally changed the term premium across the curve. And term premium, as you know, is really the risk premium that the investors demand to hold long-term debt. And that has actually gone up. And that's actually gone up more in the long end of the curve. And that's actually acutely impacting the 30-year rate more than any of the other rates. And then on the policy front, with growth slowing and the inflation expectations still being elevated, right, the Fed will potentially be on hold, which means that the 5-year rate was going to be anchored compared to the rest of the curve. So given those two dynamics, I would say the best way to position is to bet on the 5-30-year curve steepener. And what that is you essentially create a dollar neutral basket, right? So you're, dollar neutral or, kind of dollar duration neutral, 5-year and 30-year, and you're essentially betting on that spread to widen over time.
But imagine you've thrown a lot at us here. So let's break this down very quickly. What you're betting on, in essence, is that the long bonds, like 10 and 30 years specifically on your side of things, lose value, right, and interest rates go higher on the 30-year bond, and they stay either relatively stable or maybe even decline slightly on the short-term side of things, hence the yield curve between the 30-year and the 5-year getting wider and bigger. That's also something that may play out in what you would describe as a so-called stagflationary environment. Higher inflation, lower growth. Is that the thesis behind it?
That's exactly right, Dom. So basically, there are two ways the spread can widen. So the spread can widen when rates go up as well, and the spreads can widen when the rates fall down as well. Or you can see a twist, right? One end of the curve going down and the other end of the curve going up. But the scenario that we are essentially highlighting is really the stagflation, which is really where 5-year could potentially be anchored, right? And then the 30-year could go up. Now, the risk to this trade is if the stagflation fear turns into recession, the long end of the curve could potentially rally. Now, that doesn't mean that the 30-year is going to rally more. It's just that because of the elevated term premium concept that we talked about, the 30-year could be anchored compared to the 5-year, which means that you could still see what we call as bull steepening, right? Meaning the rates are still falling, but the 5-year might fall more than the 30-year, which means that the 530 could steepen.
All right, so there you go. That's the reason why. Manju Barai, All Spring, with the curve steepener trade. Thank you very much. We'll see you soon.